This video covers accounting for debt investments. Let's suppose we are Berkshire Hathaway, or at least we're the accountants of Berkshire Hathaway. And our company is going to invest money in Allbirds. In return for our investment, Allbirds is going to give us a promise to repay our investment with interest. This is a debt investment. Now, as accountants, we need to know how should we account for this investment. And so that's what we're going to go through in this video. First, let's take a closer look at this piece of paper. This is an Allbirds bond. It's a debt bond. It's issued January 1st, 2018. And Allbirds is promising to pay whoever holds this bond $10 million plus 5% interest, which is $500,000, at December 31st, 2018. So the term of this bond is 1 year, and it pays 5% interest with a face value of $10 million. There are three potential ways we could account for this same bond, and here they are. They depend on how long do we expect to hold on to this bond before selling it off to someone else. And so at the acquisition of this investment, we have to determine our intentions for holding the debt. Do we intend to hold it for a brief amount of time, in which case we'll treat it as a trading security? Do we intend to hold it for a longer period of time, which is known as an available for sale security? Or do we intend to hold it to maturity? So it's known as a held to maturity security. So there's three different accounting methods, and they depend on how long we plan to hold the debt. This is just an expectation by Berkshire Hathaway's management. First, let's go through the accounting treatment if we only expect to hold it for a brief amount of time, and this is in terms of days or hours. We call it a trading security. When we buy the investment, we're going to set up an investment account, and that investment account is always going to be held at fair value. The unrealized gains and losses that we experience while we're holding the investment are going to be recorded immediately to net income as they occur. So let's go through an example. On January 18th, we're going to purchase this Allbirds debt, and we're going to pay $10 million for it. Well, since we're paying $10 million, here's the journal entry. A credit to cash for $10 million, and a debit to the investment account for $10 million. Note that today, January 1st, $10 million is the fair value of this investment because that's what we were willing to pay for it. So our investment account is today at fair value. But now let's fast forward 6 months to June 30th, 2018. What's happened in these 6 months? The fair value of the debt has gone up by $100,000. It's now worth $10.1 million. What's the journal entry we record? Well, we need our investment account to be at fair value. So we need to increase our investment account by $100,000. That's the debit to the investment account for $100,000. The credit is to the income statement in any gain account for $100,000. So that gain will appear on the income statement during the period that we experience that gain. Now let's fast forward 3 more months to September 30th, 2018. The fair value, so part A, the fair value of the debt has increased by another $100,000. Well, that's the same exact journal entry we just did in June. We debit the investment account for $100,000 and credit a gain on the income statement. Now the total holding period gain has been $200,000, and the investment account is sitting at $10.2 million. Well, part B is now we're going to sell the investment to someone else for $10.2 million. It's fair value. So how do we sell this debt investment? Since we're getting $10.2 million in cash, we debit cash, $10.2 million, and we credit the investment account, $10.2 million, zeroing it out, taking it off of our balance sheet. Next, let's go through the accounting treatment for if you're going to hold the debt investment for a longer period of time. And when we say longer, what we mean is it's not a trading security, it's not a very short amount of time, and we're not holding it to maturity. So it's somewhere in the middle, and we call that a longer holding period. So we're going to use the available for sale method. What is the available for sale method? Well, the first part is the investment account is still held at fair value. So this is the same. The investment account is still going to be held at fair value. Here's what's different. Those unrealized gains and losses that happen to the debt investment over time, instead of recognizing those immediately in net income, we're going to hold off. We're going to hold them in an equity account called Accumulated Other Comprehensive Income, otherwise known as AOCI. And we're not going to let them hit net income yet until bullet point 3. All these gains and losses eventually flow to net income when the investment is sold. So when we eventually sell the investment, all of these gains and losses are going to flow into net income. They're going to be reclassified from accumulated other comprehensive income into a gain account in the net income. Okay, so let's look at the example. On January 1st, 2018, we purchase Allbirds debt for $10 million. Same journal entry, debit the investment account for $10 million and credit cash for $10 million. Now let's fast forward the 6 months. The fair value has increased by $100,000. Remember, we still want to hold this investment account at its fair value, but we don't let the gain hit the income statement yet. So we debit the investment account for $100,000. Now the investment account's at its fair value. But we credit AOCI in the equity section of the balance sheet instead of the gain account, and that's for $100,000. Now let's fast forward 3 months, and 2 things happen again. First, the fair value of the debt increases by another $100,000, so it's the same journal entry. We debit the investment account by $100,000, increasing it to its fair value, and we credit AOCI. We hold this unrealized gain in equity. We don't let it hit net income yet. But now, part B, we're going to sell the debt to someone else for $10.2 million. Okay, so the first part of this is we're selling the debt for cash. We debit cash for $10.2 million. That's the amount we get for the debt. And we zero out the investment account. Remember, we've been holding this account at fair value, which is $10.2 million. When we credit the account, it goes to zero, erasing the investment from our balance sheet. But since now we've sold the debt, it is time to reclassify that holding period gain from AOCI into net income. So the debit is to the AOCI account. Remember, it was holding a credit of $200,000. Now we're going to debit the AOCI account, zeroing it out, and credit a gain on the income statement for the $200,000. Finally, let's talk about the held-to-maturity method, which is when you plan to hold the debt investment until it ends for the entire contract period. This method is slightly different. The investment account is not held at fair value. It is held at cost. So you just record it for whatever you paid for it and you leave it there. Second bullet point, all of those unrealized gains and losses are just ignored while you're holding it. So let's go through the example again. January 1st, 2018, purchase the Allbirds debt for $10 million. Again, debit the investment account for $10 million and credit cash. June 30th, 2018, the fair value of the debt increases by $100,000. So now the fair value of the investment is $10.1 million. But we just hold this investment account at cost. We ignore the change in fair value. And so even if the fair value increases by $100,000, decreases, we do nothing at this point. No journal entry is required. 3 more months go by. Again, the fair value of the debt increases by $100,000. And again, we do nothing. We ignore changes in fair value as long as we're holding this investment. But part B, now we are selling the debt to someone else for $10.2 million. And this is a little against our expectations. When we decided to use the held-to-maturity accounting method, we were expecting to hold this debt until the contract term ran out. So we were not expecting to sell the debt to someone else. So this is against our expectations, but it's still possible. Here's how you would account for it in part B. Well, since we're receiving $10.2 million in cash, we debit cash, $10.2 million. The investment account is still sitting at $10 million since that was its cost. So we credit the investment account by $10 million to zero it out. And the balancing credit is to a gain on the income statement for $200,000. That's the entire holding period gain. So, to recap, the expected holding period is what determines the accounting method companies use when they account for debt investments. If, when a company acquires a debt investment, they expect to hold it for a brief period of time, you use the trading method. The investment account is held at fair value, unrealized gains and losses recorded in net income. If you expect to hold it longer than brief, but not until maturity, you use the available for sale method. The investment account is held at fair value again, but those unrealized gains and losses are held in AOCI, an equity account, and they're only reclassified into net income when the investment is sold. Finally, if you expect to hold the investment to maturity, you use the held-to-maturity method. The investment account is held at cost, and all of those unrealized gains and losses are ignored.